Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is John Leer, economist at Morning Consult, to discuss why consumer confidence is an important economic indicator, where the economy stands today, and what it will take to make confidence improve in 2021. John, it's great to see you again. Welcome back to Trade Talks.
Thanks, Jill. Great to be with you.
Why is consumer confidence such an important economic indicator?
Sure, it's always an important indicator, but particularly during the ongoing recession, it's been a great leading indicator of consumer spending. So in the US, we've seen in our data roughly 0.9 correlation with real personal consumption expenditures and retail sales. So if you want to know where consumer spending is headed, consumer confidence is a great indicator.
How long has Morning Consult been tracking consumer confidence? How do you measure that?
Sure, yeah. So we track consumer confidence every day in the US, and then across the globe, we track it in 15 countries every day. And it goes back to January 1 of 2018, asking people their views of their own personal finances, their economic outlook as a whole, and then whether or not it makes now is a good time to make a major household purchase. And together, those indicators give you a great sense for not only what consumers believe currently, but also sort of their future expectations.
Why didn't consumer confidence improve in response to the development of a vaccine? When do you think that's going to start to improve?
Sure. A lot of it has to do with the challenges that consumers face in terms of their personal finances. So for higher income Americans, we did see an increase in consumer confidence when that vaccine news broke, in large part because they have the financial wherewithal to weather the storm over the next 6 to 7 months. Middle and low income consumers don't. We track on a monthly basis personal finances, and 30% of Americans making under $50,000 per year really aren't able to cover their basic expenses using their savings. And so this financial vulnerability is dragging down consumer confidence right now.
So then where does the economy stand today, and how far will the stimulus go to help with the economic recovery?
Yeah, we're really at a turning point right now. I think November and December will go down as two of the worst months for consumers in the US. I expect to see consumer confidence and spending gradually increase over the course of the month. Those spending checks are the stimulus checks are going to hit people's bank accounts early in the month, and then over the course of the latter half of January and February, we'll start to see the enhanced federal unemployment insurance.
So then I guess the question is, how long do you expect those effects to last? Was the second round of stimulus enough to support low-income Americans?
It certainly is not going to solve all of their problems, but what it does is it provides them a bridge to last until some of those unemployment insurance benefits kick in. And additionally, once people start spending more money, we should see the demand for labor start to increase. And so I think we'll see just broader, stronger economic activity through the end of the first quarter, before probably the second quarter we'll start to see some level of uncertainty as financial vulnerabilities emerge once again.
And I guess the million-dollar question is, when will widespread vaccines start to improve the economy? I mean, realistically, by the time this gets through the population, how long will that recovery take?
Yeah. We're likely to see 4 distinct phases over the course of the year, with higher income consumers showing sort of resilience in the first half of the year. But it won't be until probably the third quarter when we see a real rebound in consumers' willingness to engage in basic household activities like going to concerts, going to restaurants, just traveling again. And that's when I'd expect to see a widespread boost in economic activity. And then by the fourth quarter, we probably are going to see something more like the new normal, where some of those longer term challenges are likely to rear their head.
And John, to wrap up here, and I don't think enough people in financial media are asking this question, what are some of the potential long-term, the scarring effects of the pandemic recession? Yeah. It's not like you flip a light switch and this just goes away.
Certainly not. I mean, if there's one thing that we've learned, people who study recessions know that these scarring effects are very real and they last a long time. In this particular recession, I think the biggest concern is the duration of unemployment. It's very difficult to go back to work for an employer who no longer exists. And so as we have all these bankruptcies and small businesses going out of business, that labor force is going to struggle to find a new job. And in particular, it's going to be challenging because a lot of the industries that have suffered during the recession really aren't going to be there demanding labor on the back end. And so there's going to be this sort of skills mismatch, an industry mismatch that will take some time to sift through.
All right, John, great insight. Great to see you as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.